5.5 months ago, I made a YouTube video trying to show that doing little to no research, as in only 6 minutes, and then investing based on that 6 minutes of research, was a bad idea. Of course, 5 months ago, New York University put out their study showing that the median investor now in 2025 only spends about 6 minutes doing research on stocks before investing in them. Furthermore, some of the findings in this research report showed that a lot of the investors, after they had tracked hours and hours of screen time, didn't even make it past simply looking at the charts. Now, go back in time 5 months ago to Torrin Dove Financial, where I sat down with the timer 3 separate times and gave myself exactly 6 minutes to do research and try and find a stock. I started with a screener, I started with news sources, and then I of course started with trying to just do whatever I could in 6 minutes. And I came up with 3 investment ideas that I would be putting money where it belonged with those high quality investment ideas. Now, I picked the best idea out of the 3 that I could find, and that was of course Google. Now, I accidentally proved that doing 6 minutes of research is more than enough research for you to part ways with your hard-earned cash and put it into investments. And that means I had a 70% return in 5.5 months, which was the exact opposite of the finding I was hoping to find so I could come on and give a good speech about doing your due diligence. Now, a lot of things had to go right in order for this one position to work out. In fact, it was the only one out of the 3 positions in that video I came to that actually outperformed the market. We had FedEx, we had Schlumberger, and then we had Google. Now, Google could have been the cultivation of combining a bunch of different factors that are in high demand right now, specifically more short-term factors, that of course being the momentum factor and the growth factor. And honestly, one might even throw out the advances in technology factor, just some random factor in the factors too. Now, what actually happened in these 5.5 months that made Google go up 70%? As I said in that video, I did my absolute best to make sure I could not answer that question when this video happened. I limited myself to those 6 minutes of research, and damn it, I stuck with those 6 minutes of research, which basically boiled down to, out of the tech companies, it's kind of cheap and it's not doing hot right now, so maybe this would be a good value play in this space. And if anything got brought up about Google, I tried not to necessarily pay attention, which was quite hard because as one of the companies in the AI race, Google is going to be in the news a lot. Now, at the end of this 5.5 months, as I said I would do in the video, I did sell my position in Google. Why 5.5 months, you may ask? Well, over time, starting in the 1960s, the average holding time for a stock in the average person's portfolio was 8 years. Today in 2025, that number is 5.5 months. Yes, we are deteriorating. As a lot of you who, if you're clicking on an investment-related video, specifically on a pretty small channel, you're probably going to know exactly what I'm saying right now, but a lot of you will know that 5.5 months is not enough time for a company to really, prove or do much of anything. You create the quality thesis, hopefully, in 6 minutes you probably can't, but you hopefully create a quality thesis and try and partner with a company for long term, and then in 5.5 months you sell it instantly and don't look back. This is not a recipe for good financial decisions. Just because it worked this one time in my portfolio does not mean it was a good decision. In fact, if I had gone with FedEx, I'd be looking at a 3% return. And if I had gone with the Schlumberger, I would still be below just parking my money in an S&P 500 ETF and letting it ride. I didn't try and make this video to show, you can beat the market with little to no research. I tried to show how risky it was to throw money into a position you barely know about. I did my best to not keep up with any acquisition news, any updates, any partnerships, nothing. I don't really have the good indication of where Google has gone in the past 5.5 months, because the average investor doesn't. When I talk to what I would consider more like the average investor for today, and again, this is coming from somebody who I go to school in finance, so the people I'm talking with are other finance kids, and they still, a lot of them, they don't really know like any of the updates that are going on. You would be shocked. It's kind of concerning to say, oh yeah, I have like an 8% allocation to this company in my portfolio, and then I'll try and talk to them about where they rank in the AI race, because that's the big thing going on right now. And they're just like, well, it's Google. Yes. Yes, it is Google, and that may be enough to some investors, but that's not enough to me. I want to look underneath the hood. I want to keep up with what's going on, and I want to have a general idea of at least being able to put some confidence metric that if this position were to go down 50%, I would not automatically sell it. Now, just because the video update was a massive failure in terms of trying to show why it's bad to only do 6 minutes of research into investment companies and then partner with them, I figured in the long run you will still be significantly better off not doing this strat. And in order to just prove that, you can go look up the average return of a retail investor. Better yet, I'll pop it up on the screen for you. It's not good. It underperforms quite a bit. And when you take out CPI, you're pretty much better off just only getting municipal bonds at that point. It's really something that's quite sad. So, again, you can get away with doing little to no research, especially if you're going to be trying to look at companies that fit into short-term factors that will probably do well based on recent events, i.e. momentum. Momentum is having a moment. But long-term, if we look at it, momentum is still not a good factor comparatively to pretty much any value factor. So, again, that was a little bit of a snippet on my personal experience with this. I also, in order to kind of run an experiment I could come talk to you guys about, I actually, in my investment club I run, kind of tasked the group with doing a similar activity. See, I think part of the reason that I didn't get the results I expected from doing little to no research and then investing in companies is because I kind of have an indication of what to look for. Now, in 6 minutes, I'm not going to sit here and pretend like I can walk you through like a 20 PowerPoint on why I believe in a company, give it a good target price, throw in some valuation models. Like, there's none of that in 6 minutes. 6 minutes is a ridiculous time frame. But what I could do is go onto a screener and search for different categories and ratios pretty fast that would give me an indication that maybe a company is slightly undervalued, or is going to be having a little bit of momentum in the future, and I can kind of get a better guesstimate than I would consider a lot of people who don't even know what a screener is. So, in order to run this experiment again, I tried to kind of balance out the whole entire, these are going to be people who have at least been through a class with, I consider, quite good instruction for my school personally. And I balanced that out by setting the timer up on the screen and also reading out time marks. So after like a minute and a half passed, I'd be like, okay, you guys have 4.5 minutes left. So we did 3 separate rounds so I could try and gauge some quality investment ideas out of these people. And I was actually pleasantly surprised in that a lot of them were very honest in the confidence they would put in some of their companies. So for the first round, what I did was I just let them kind of start on whatever news source they wanted to and just find ideas based on that news source. Now, a lot of them were actually quite honest when they pitched their ideas to our club, being, oh, I'm not super confident in this. I'd rate this probably like a 6 or a 5 based on this. I need to do more research, which I was quite happy about. What I also found was, even though we are taught in an academic setting that technical analysis, looking at charts, it doesn't actually predict future returns, and you're better off not just staring at the 1, 3, and 5 year charts, these people still defaulted back to that because they were under such a time crunch by trying to compact what should be a month-long process into a 6-minute process that they just immediately defaulted to, oh, it's up 50% since then, or oh, it's down 15% since it's high at this. And I thought that was kind of interesting, considering that we're taught not to do that, and then when you actually put people under pressure, it completely snaps their quality in terms of investment ideas. So that was the first round. The second round, we started out with a screener, and I gave them regions that they would have little to no experience looking in. So one group I tasked with either finding me something in Finland or Switzerland that we could invest in. And one group I went around and I said, find me some publicly traded companies in Africa that we should add to our club's portfolio. And would you believe it? It was a really, really difficult ask for them. And you're dealing with a lot of risks that you don't even have time to think about. And I might have been evil with some of my questions. I may have asked what geopolitical tensions in that area would affect the companies, and they didn't have a solid answer, which I think is fitting because a lot of people, if you talk to them about the actual risks associated with their investments, they don't necessarily have a good idea of the full picture. Now, I always bring this example up because I think it's the most fitting to show what I mean by understanding the risks. I think typically when I look into 10Ks for what I would consider higher quality companies, which there are like quite a bit, but the risks are going to be very, very general. So right now, if you take the example of Google, there's going to be something in there about the massive AI spending and what happens if that slows down, or we could be subject to like the Russia-Ukraine war or something. Like, there's going to be a lot of the more general things that affect a lot of the firms around them as well. But when you get into some of the bad firms, and this has been my favorite example I've ever brought up. So when I got tasked with valuing Brown-Forman, the parent company behind Jack Daniels, the first risk on their 10K in the risk section was most of our sales come from our Jack Daniels line of products. They're selling less than they were last year. That was the very first list or risk that was put on the thing. But that's something that not a lot of people would get to because surprisingly, most of the people even in this study didn't even navigate over to any form of report, filing, anything. Most people probably don't even know what a 10K is. I've been shocked at some kids in my classes who you talk about a 10K and it like goes over their head and you're like, you're a senior in finance. What do you mean you don't know what a 10K is? So yes, you're going to get a lot of those people that don't actually know the risks that are associated with their firms. And if you don't know the risks associated with your firms, it's really easy the second something goes minorly wrong to not be able to identify between, okay, this is a general risk that is going to affect a lot of companies in this space. It's not something to necessarily panic sell over, versus this is a firm-specific risk that has been touted that means the company is doing X, Y, and Z, and they're flunking on these parts and I need to get out. People can't really identify and have the confidence to understand whether or not, okay, I'm seeing some negative share price action in this company, so therefore I need to vault ship, which most of the time is not the answer. I know, very shocking. The stock market only goes up and to the right. I know. We've been very, very fortunate these past 3 years. But sometimes it doesn't, and that doesn't mean it's time to panic sell. You got a lot of that the second that Liberation Day happened and people suddenly were leaving very good, high-quality companies that at the bottom and then freaking out. Those are the types of people that should not be in equities, or if they're going to have equity exposure, should be in a fund. But yes, moral of the story, 6 minutes of research isn't enough for even people who are going to school to learn things about what you actually look for in quality investments. It's not enough time for that. And if it's not enough time for people who are familiar with the space and they freak out and panic in the second you say, okay guys, we're going to be looking for micro caps in 6 minutes, and they're just horror on their face. We had multiple kids be like, hey, I know we were supposed to find a good investment opportunity, but how about a potential short? We had a lot of that. So I think it's a good indication that if people who are even attempting to try and learn more in the space in an academic setting freak out at the prospect of investing in companies based on 6 minutes of research, the average investor should not only put in 6 minutes of research. If you don't have time to research individual stocks, for some reason, there's this whole misconception about passive investing is giving up on becoming rich or something dumb, and you see it a lot. It's not. Passive investing is the best option for 95% of investors. It is. If you don't have the time to research quality single stocks, then don't try and do single stock selection. There's no need to. So, overall, thank you. That was my little rant and part 2 to a wonderful video on why you should only spend 6 minutes researching before investing. Thank you very much.